Redfin says that there's 630,000 more sellers than buyers in this market right now. That's the biggest gap on record since 2013. They're claiming it's a buyer's market. But is that what you really feel out there? If there's so many sellers and so few buyers, what's exactly happening to prices then? And more importantly, what does this say about the direction of the national housing market? All the national data and more covered in this week's San Diego Market Matters, and I'm Karl, your San Diego realtor. Now, real quick, if you haven't liked and subscribed yet, feel free to do so now, or you can wait until the end of the video. Either way, I appreciate you for doing it. Now, let's dive into the data. Let's start with the number that drives a big portion of this conversation, the 10-year Treasury yield. Most people never look at this, but it's the engine under the hood that moves the mortgage rate market. When the 10-year Treasury goes up, mortgage rates tend to follow. When it drops, rates tend to ease. The 10-year closed out this week at 4.42%. Back in February, that number had dipped down to around 4%. A lot of buyers took that as a signal that relief was coming in mortgage rates, and it did, briefly. Then the Treasury started climbing this month, and it's been on the way up ever since, particularly as a result of the Iran war. The climb is the reason mortgage rates are where they are right now. The 30-year fixed mortgage rate closed out the week at 6.64%. At the beginning of March, that 30-year rate was about 6.1%. This helped a lot of buyers who had been patiently waiting on the sidelines for rates to come down. Then the Treasury started climbing and rates climbed right along with it. We went from 6.1 up to 6.64 in about 3 weeks, with expectations of rates hitting 6.75 by the end of March. That's nearly half a percentage point in less than a month. On a $600,000 loan, that's roughly $160 more per month. For buyers trying to make the math work, that kind of move doesn't go unnoticed. Now, here's something most people don't look at, much less even think about when it comes to mortgage rates. The Treasury rate is the wholesale price. It's what lenders use as their starting point. Your mortgage rate is what you pay at the register. The difference between those two numbers is the lender's markup, AKA the spread. Right now, that spread is sitting around 2%. Typically, this is closer to 1.7%, so lenders are still charging a bit above historical norm, but significantly less than they were in 2024 when that markup was above 2.5%. That was a painful time for buyers. Think mortgage rates around 7.5%. Now, we've come down a good amount from there. Here's why this matters. When the 10-year Treasury drops, we expect mortgage rates to drop with it. But if lenders don't reduce their markup at the same time because maybe they feel there's a lot of risk in the market, that benefit never shows up for the buyers. And this week, that markup, AKA the spread, ticked back up. It's not alarming yet, but it's something we need to keep our eye on. This next metric tells us whether buyers are responding at all to this, the Mortgage Purchase Application Index. The number of people applying for mortgage purchase loans right now is tracking higher than it was at this point last year. That's a positive signal. It means buyers haven't walked away from the market despite prices elevated and affordability being the primary topic with regards to everyone's finances. You know what's crazy? At the Padres game this last week, I spent $53 on a beer for myself and a michelada for my wife. And the beer I got was only a Pacifico. I get why affordability is so outrageous right now. The question worth asking is if mortgage application trends hold. Rates climbed nearly 0.5% in about 3 weeks. Applications typically respond to rate moves with a short lag as buyers tend to pull back a few weeks after rates go up. If the next few weeks show applications holding strong, spring demand is real. If they start to drop off, that'll be the first sign the rate move is having an effect. This is one to pay attention to going forward. And another reason mortgage applications have sustained is in part due to the job market. Jobless claims measure how many people file for unemployment benefits in a given week. The most recent number was 205,000. That's near the lowest we've seen in 2 years. Now, if you've been following the jobs data, you may know that it is all over the freaking place and it comes with a lot of revisions. Nevertheless, the data coincides to a degree. When people feel secure in their job, they make big financial commitments. That steady buyer activity we're seeing in pending sales and mortgage applications is partly a reflection of that confidence. Employed people buy homes, nervous people wait. Right now, people feel employed and confident enough in the job market to continue to buy homes. Now let's take a look at the national new listing data. New listings came in right in line with where they were at the same point in 2023 and 2025. Sellers are coming to market at a normal seasonal pace, not a flood, and at the same time, not a drought. Here's the thing to watch going forward. In both 2024 and 2025, new listings climbed meaningfully from March through May as the spring season kicked in. If 2026 follows the same pattern, buyers get more options over the next couple of months. Whether that supply gets absorbed quickly or starts to build up will tell us a lot about where pricing pressure goes this spring and into the summer. More listings hitting the market is good for buyers, but many sellers are bringing those listings and are still having to adjust their price expectations. About 1 in 3 homes on the national market right now has had a price reduction, and that's running higher than where we were at the same point in both 2024 and 2023. But here's what makes this number so interesting. Mortgage rates in 2026 are lower than they were at the same point last year. Lower rates should give buyers more purchasing power, and you'd expect sellers to need fewer price cuts to get a deal done. That hasn't happened. Price reductions are running at a very, very similar pace to 2025 despite the better rate environment. That tells you that the issue isn't purely about mortgage rates right now. Buyers are holding back for a number of reasons. Overall affordability constraints, economic uncertainty, job market anxiety, general noise in the world, what have you. The rate equation has improved slightly from where it was last year. The buyer's psychology hasn't exactly followed suit yet. Even with that hesitation, buyers are still making moves. About 360,000 homes and counting are under contract nationally in March, and that number is trending upwards. It's keeping pace with where we were at the same point in 2024. People are buying homes, folks. And this is where the Redfin data that I mentioned at the beginning of the video gets really interesting. Redfin says that the pool of active buyers, people that are actively searching and touring, is smaller than at any point since 2013. Their site is saying that there are 630,000 more sellers than buyers based on the data from February. But another source, Housing Wire, the provider of most of the data I'm sharing with you in this video, says that the number of deals being signed is still keeping pace with 2024. So how does any of this make sense? We have mortgage applications up, probably due to interest rates coming down since this time last year. And at the same time, new listing data is comparable to 2025. Also, if there are so many sellers and so few buyers, then why aren't price reductions going through the roof? I'm not sure that the math from Redfin exactly lines up here. Regardless, the data shows that buyers in this market right now are motivated. They're not window shopping. If you're a seller, this isn't a dead market. It's a selective one. Price it right and it moves. Overprice it and it sits. Simple as that. Now that'll be $495 for my wisdom, please. My Venmo is in the description below. You're welcome. Now let's look at the national inventory. Right now we're sitting at over 705,000 single family homes for sale nationally. That's higher than we were at the same point in both 2024 and 2025. So buyers do have more options than they did in prior years, but here's the catch. Inventory has barely moved since January. It's been essentially flat for 3 months. In 2025, inventory was growing steadily at this point in the year. In 2026, it's holding still. And that flat trend is worth watching. If pending sales keep trending upwards and supply doesn't grow alongside it, the window of opportunity for buyers isn't going to stay open forever. Bottom line, we have continued evidence that the market isn't frozen. It isn't crashing either. It's grinding forward with a smaller, more motivated buyer pool and a flat inventory that isn't building up any cushion. The buyers who are out there are moving with purpose. The sellers who price accurately are still getting deals done, and in many cases, multiple offers are still possible. Before we close, Redfin broke down their buyer-seller data by market, and they have San Diego listed as a buyer's market with 18.8% more sellers than buyers. I'm not fully convinced that that reflects what's actually happening on the ground here. But you'll have to come back and find out next week when the local San Diego drops and we pull the actual MLS numbers against that claim. If you're willing to take a bet, drop it in the comments below. And that's a wrap for this week's San Diego Market Matters. If you haven't liked this video yet or subscribed, here's your last chance to do so before the video comes to an end. Thoughts, questions, or concerns, don't hesitate to reach out. As always, I'm Karl, your San Diego realtor. I'll see you in the next video.